Hi, this is Mike Larson for Money and Markets TV. As Treasury Secretary Timothy Geithner told us earlier this week, we've officially hit the debt ceiling. And in early August, he'll run out of strings to pull to keep us from defaulting. That's already undermining confidence in U.S. government bonds. Meanwhile, we're all paying more for everything from gas to food. That's driving investors to seek out hedges, including commodities like metals. And we're also spooking our foreign creditors with massive borrowing and spending binges. That's putting pressure on the US dollar. But today, I want to talk about what I call the forgotten crisis, the economic crisis, because we are undoubtedly facing one based on virtually all the incoming data I'm seeing. The government's massive economic stimulus package 2 years ago, and the Federal Reserve's unprecedented wave of money printing since then, haven't bought us much. We've printed, borrowed, and spent more than $2 trillion. And all we got in return was a few quarters of tepid GDP growth. Now, the end of QE2 is just 6 short weeks away. And the federal government is tapped out. As I mentioned, we've already hit that debt ceiling. So we're left with an economy that has to stand on its own 2 feet. And it appears that it just can't do it. GDP growth already slowed from 3.1% in the fourth quarter of 2010 to 1.8% in the first quarter of this year. And now it looks like things could be even worse in the current quarter. Plus, the bad news just keeps on coming. The Empire Manufacturing Index, which measures activity in the greater New York area, was nearly cut in half in May from a month earlier, a much bigger drop than economists were expecting. The NAHB's Housing Market Index, which measures builder confidence, remains mired in the muck this month. At the same time, April housing starts plunged 10.6% and building permits slumped 4%. We've now been stuck at a dismal level of about 500,000 to 600,000 starts for 2.5 years, despite hundreds of billions of dollars in aid being thrown at the market by the so-called fixers in Washington. Meanwhile, industrial production flatlined in April, confounding economists who are looking for a gain of 0.4%, and factories used just 76.9% of their available capacity, far below the 77.6% that the market was expecting. It all adds up to an undeniable conclusion, that the American economic engine is starting to sputter again. I'm taking steps to protect myself and my subscribers from this forgotten economic crisis, and they're starting to rack up profits as a result. Now, I can't share all my tactics and techniques with you here, but I will say that I've been taking gains off the table on longer-term trades and aggressively playing the downside in my shorter-term trading services. My recommendation to you is to consider establishing some hedges using inverse ETFs that rise in value when parts of the stock market fall. One good example is the ProShares Short S&P 500, ticker symbol SH. It's designed to climb 1% for every 1% drop in the S&P 500, and it can go a long way to providing peace of mind. So far, this is just a slowdown, but I'm definitely keeping my eyes on the data to see if it turns into something more, like a bona fide recession. Stay tuned, and until next time, I'm Mike Larson for Money and Markets TV. Thanks for watching.